to you by Founder Institute. Going to be a very interesting discussion, looking at a lot of practical tips and tricks and processes on how you might go about unlocking checks from angel investors, which is one of the key questions that we get all the time from our founders that go through the program is, how do I raise capital? I'll tell you, get some inside running on how to do just that. 3 amazing individuals joining us today. So I will introduce them a little bit more fully as just before we jump into the panel. But Daniel, Debra and Philip. Here's our agenda for this evening. Introduction to what Founder Institute is all about. And as part of that, I just wanted to highlight too that we've got a couple of further events that are coming up quite soon. Next week we have the graduation of the current cohort of founders from Founder Institutes. They've been working incredibly hard over the last 16 weeks, and that's a public event that you can feel free to come along to. And then the week after that, we have another event you may wish to join, which is a pitch to actual real investors. So there's some individuals coming along from Blackbird Ventures and Taronga Ventures to join. Now, before we get fully started, want to acknowledge our amazing partners. So Addison's, awesome startup-friendly law firm based in Australia, and does have some good connections to different firms in New Zealand, by the way, for those joining us in New Zealand, and our other local community partners who help make our program what it is. So to tell you just a little bit about Founder Institute, so Founder Institute is the world's largest early stage accelerator program, and we help turn ideas into high scaling ventures by really focusing on the founders and the education of how to make that possible. So as you can see, some of the facts and figures here, a lot of success over the last dozen or so years that the program has been running across many countries and many cities across the world. I think around 200 cities, so lots of different success. Locally across Australia and New Zealand, this is the team of directors, including myself, Benjamin, Phoebe, Paul, who's online tonight as well, that bring the program to you from a diverse background, from investing through to product and other things. And also our amazing venture partners who are located in cities around our region to help our founders, and based on their practical experience being founders themselves, and all amazing community connectors. So Founder Institute itself, it kind of sits a bit in the middle between different other programs you might be familiar with, things like Startup Weekend and such that might be at the very, very idea stage, super early, and between that and acts as a bit of a gateway to some of the later stage accelerator programs, where you can really learn, I guess, the grassroots practical things that you need to know to build an idea into a venture that can scale. A key part of that is firstly finding amazing people. People are absolute key ingredient in startups, and then connecting them to amazing mentors, also the global support network that we have, and taking them through a very structured process to get them on the journey, as we'll talk about in a second, and also beyond that, key support. So the typical types of founders that might join the program are those that may, in quotes, just have an idea. So that's perfectly fine. You may be a sole founder, you might have your team and a prototype, or you might even be off and running with some customers and some revenue. And that then links into 2 different tracks that we have, the launch track and the growth track. And so for the launch track, you can see here that there's all sorts of different topics that are offered across the 14-week program. And in each topic and each week of the program, the 14 weeks, we have mentors coming in and giving their masterclasses of hints and practical tips that they've they've gathered over all their years of growing and managing startups. And for the growth track, similar topics, but especially in the earlier weeks, given more advanced subject matter. And all the items that you're working on as part of the structured program are designed to move your startup forward. So whilst you're learning new skills, new information, it's all, every week it's about applying that to your startup to move it forward. So it's not like you're going off and just learning about something that doesn't have any relevance. It's actually advancing and accelerating your journey by years in just a matter of weeks. And so what we do have now too also is a new track, which is our climate track. And so this is focused on climate tech companies, and with a mission to inspire over 1,000 founders from Australia and New Zealand, the slide should say, to build companies that can solve huge problems that are happening today. And certainly the area of climate tech is one of the great opportunities currently that exist, as well as one of the key problems that we need to solve as humanity. Beyond the program, there are lots of amazing additional programs that exist and support. So once you graduate, then you have the opportunity to go into a further program, which is very focused around funding, and then also be part of even a fund that's run globally as well. So, and that's all on a merit-based and invitation basis. Some of the different companies that have graduated from Founder Institute globally and gone on to success shown here. So ones that have reached $1 billion plus unicorn valuations, and including ones that you'll see on the far right that have come from Australia as well. And those have received funding from mentors and people in the program, as well as funding from external sources. So the process has been proven over literally thousands and thousands and thousands of startups. It's based on a structure that is set up for success, and also, as mentioned, connects you in to amazing mentors. I think across Australia and New Zealand we have about 280 mentors. So it connects you into an incredible network locally, but also across the world there's about 20,000 mentors. So it's just an amazing resource to draw on as you grow and scale your company into different markets and need different skill sets and help. So for the program, there's some important dates to be mindful of. So early admissions deadline for the next program. So we run 2 per year. As mentioned before, the current semester is just about to graduate next week. The next semester will start in March 2023. And so the early admissions deadline to apply for that is December 11th. So best to get in by there. There's slightly lower fees to do so. And then final deadline is the 26th of Feb. And then that program goes through until June 13th. So how to apply, there's a link down there. Now to introduce our amazing mentors. Firstly, Daniel Bignold. So Daniel has an amazing background as a serial founder. So I think around 8 companies you've founded, and many of those achieved successful exits, which is what we're all trying to do. Currently entrepreneur in residence at ANZ, it's Innovation Hub and Centre, which is great. So based in Melbourne. So thank you for joining, and looking forward to hearing your practical tips as having gone through the journey to raise capital. Next we have Debra Hall, coming in from New Zealand, and you're in Auckland, aren't you, Debra?
Yes,
Debra?
I am. Yes, I am.
Yeah, cool. Didn't want to get that wrong. And yeah, so Debra's got an incredible background working with startups of all sorts of different levels, both as an investor, quite actively mentor, also sitting on boards, and participant in different industry bodies such as Flying Kiwi Angels, which is Angel Syndicate we'll hear a lot more about in just a moment. And then also KiwiNet, which supports commercialisation in scientific-based groups as well. So thank you, Debra, for joining.
Thank you.
And last but not least, we have Philip, who has Philip Argy, who has an amazing background on the legal side, which I'm sure is helpful in your mindset that you bring to investing, but also incredible background as a very active investor and community member at Sydney Angels, which again, we'll hear a little bit about Sydney Angels later and how they actually work. So based in Sydney, thank you very much, Philip, for joining this evening. So
thanks.
Very much appreciate it.
Took a little bit of perseverance and a little ingenuity, hence my background, in case that was not too obvious.
Yes, yes, well done. The perseverance, that's good. I get it. Nice. Cool. Okay, so we'll jump into the questions. Now, for everybody who has joined, we will have audience questions. So after I ask a few questions of the panel, so please do add your questions into the chat or the Q&A, and we'll pick them up from there when it comes time to throw out to audience questions. So that would be fantastic. Okay, so first question is going to be for Daniel. So Daniel, founders often ask us if they can raise capital, like when they've just got an idea, or just or have a product, or haven't yet got customers. So they're wanting to know, like, what do I need to do to actually raise capital? How does a founder know that they're actually ready or in a position or likely to be successful in raising capital for their startup?
Okay, big question to start. So firstly, good evening, everyone. Thanks for having me on the panel. So look, as Chris mentioned earlier, I'm sort of talking from a founder's perspective, having done it a few times now, probably a little bit of a sucker for punishment, doing it multiple times. But look, for me, in my experience, I've always thought about it in terms of getting external investment in a few different ways. So firstly, when I'm starting a business, you can obviously think about self-funding that. You can think about family and friend rounds. You can think about maybe debt, or bank loan, et cetera, or maybe angel investment. And for me, in the businesses I've been involved in, they're sort of smaller tech businesses initially. So we've always thought about it in terms of a pre-seed versus seed. So pre-seed is where we want to obviously embark on making sure that we identify a bit of a problem solution fit. And that's usually done under a self-funded means, in my experience, and wanting to make sure that we've got a clear problem here that we want to solve. And maybe even a little bit of concept testing, prototyping, et cetera, to prove that. And once I feel confident enough to move into sort of a seed round, that's when I would possibly think about getting external investment from an angel. And so I'm basically then saying that I'm clear that I've proven this concept. There's a core need here. There's a problem to be solved. And it's tested well. And so I'm now ready to dive in almost full time to this, to really dive in and prove out the product market fit. So obviously, embark on the MVP and product pilots, et cetera. So that's usually the structure I think about it. And for me to actually find, that sort of investment externally, I've had probably a bit of a different path because when I started out in startup phases, I actually met a few angel investors along the way that I didn't need investment at that time. And so when I sort of then, was moving through to other opportunities, they always said, look, if you come up with something that sort of fits my portfolio, please give me a call. And so through my network that I was building, I actually then had opportunities to just go direct to some of these angels, pitch an idea, and was lucky enough to be successful with getting that. So Chris, do you want me to dive into further there, or that's enough for the moment?
That's probably enough for a moment. Yeah, and keen to hear more a little bit later to dig into that a little bit deeper. But yeah, that's great. So Deborah, might turn to you next. So many in the audience are likely to be first-time founders, and I know for myself, when I was starting out raising capital for the very first time, I remember asking a mentor, like, is there a book that tells me about how you can do all these things? And he was like, no, sorry, there's probably more things these days, but still very hard. And something that was an epiphany for me was when somebody actually took me through what the business model is of angel investors, like how do they seek to get a return on investment, and so you can then understand better what they might be looking for. So yes, it'd be great if you're able to enlighten us on the business model of angel investors, maybe how it works at Flying Kiwi, and also what they might look for.
So I mean, I guess I would preface all of this by saying you really need to think about, do you really need to raise money? You know, the first advice I give to founders is that customer dollars are much better than investor dollars in moving your business forward. So, taking other people's money comes with positive aspects, but it also comes with hooks and responsibilities. And I guess part of that responsibility feeds into your question around what the angel business model is. All angels are different, but in the end, we need to I guess we need founders to understand that in some shape or form, we're investing to get our money out multiplied as opposed to incremented in some way. So when I say that, the reason, you'll hear angels talk about wanting a 10x return. Obviously, that depends how long it takes as to whether 10x is appropriate or sufficient. But the genesis of that is that so many startups fail. Even the best angel investors don't have a fantastic hit rate of picking winners. And so of all the things that I invest in, I need to see a credible path to getting my money out, or to getting, for argument's sake, 10 times my money out at some point. And so the question that I would ask founders is, are you going to use this money to create the type of growth that will potentially give you and me that sort of multiplier effect on our investment in this business? It sounds incredibly mercenary, but the reason I need that level of return is because of all the investments I make, and I've got a portfolio now of 35, 40 startups that I've invested in. The reality is that probably only 2 or 3, if I'm lucky, of those will pay back everything I've invested in all of them. And so, it's a numbers game, and I can't tell which those are at the beginning when I invest. So having said that it's incredibly mercenary, the reality, at least in my angel circles, is that many of the angel investors are not primarily driven by the potential for financial return. Yes, it's a high risk, high reward investment, but many of the angel investors also have other motivations to invest in this space that speak to their desire to give back their success to the next generation of founders, that have the kind of personal need to stay connected. Maybe they retired. They often older men. Maybe they've retired and they want to stay connected to the next generation of technology and innovation. And so those motivations are at least as strong for many angels as the yes, I want my money multiplied and I want a very high return on at least some of what I invest in.
Yeah, great. And is there any? Oh yeah.
So Flying Kiwi's process is a little
Yeah.
different from the normal angel group. Normal angel groups generally have some kind of deal flow screening committee that screens potential applicants as to whether they believe this will be of interest to their members. At Flying Kiwis, we believe that a deal needs a champion. And so a founder needs to find one of our members who is sufficiently interested in investing themselves in this business to champion the deal to the other members. And they can only present to the group once they've found that champion. And then we go through after the presentation, we go through a voting process as to whether to do due diligence on that presentation. And once the DD team has produced a due diligence report, that then gets voted on again as to whether the company should become a portfolio company.
And does Flying Kiwi then invest as a group, or do the individual angels directly invest?
We have a very small committed group who've undertaken to put a very small amount into every deal. But in general, the vast bulk of the money comes from individual angels who write, as you've indicated in your blurb, checks of various sizes, probably ranging from, at the first round, probably ranging from individual 5,000 to, what's the most I've ever seen? I don't know, 50 maybe, occasional hundreds.
Yeah. Okay, great. And is there anything in particular that, well, I'm sure there's many things, but what are some of the examples of things that you'd be looking for in startups as a generalization? Yeah.
In New Zealand, we have this Māori proverb about the only thing that matters. Shortened, it says he tangata, he tangata, he tangata, which the translation is the people, the people, the people.
Okay.
At seed stage, 80% plus of the decision is about the people, which speaks to why Daniel, as a repeat offender, finds it easier to raise money, because obviously the more successful runs on the board you've got as a founder, the easier it is, and you know who the investors are, and you've maintained your relationships with them even when you're not raising. All of that speaks to how you become successful as a repeat founder in raising money.
And are there any particular qualities or kind of dynamics or structures of the people or teams?
I say I try not to invest in psychopaths.
Okay.
Every angel investor has had a bad experience, at least one bad experience with a founder. Most founders are fabulous, interesting, super intelligent people, but occasionally you have this experience where you go far out. I think it's this dilemma of wanting people with huge ambition and incredible courage, because realistically, if you don't have courage, why are you doing this? Just go and get a day job, go and get a proper job. And then at the same time, angel investors talk about needing that person to be coachable. And so we want people who will take advice, not blindly, but who are open and open-minded to other people's views and experiences. Who are willing to learn from other people's mistakes, I suppose I would say, as opposed to having to make the mistakes themselves. But then we also want these people who are driven and opinionated and self-confident and ambitious. And so it's quite a high threshold.
Yes, delicate balance. Okay, well, we'll come back to, I've got a follow-up question for you that is related to kind of that relationship between the angels and the founders. Until then, might move to Philip. Question for you next. And this is probably a little bit of a somewhat technical question, dare I say. But angel investing and angel capital can come in different forms. And again, for the uninitiated first-time founder, it's hard to know, like, what are these terms? What are they actually all about? And quite true that if you do the wrong kind of deal, not only could you be doing a bad deal for yourself and for your company, but you could even block yourself for future rounds. So it'd be great if you're able to tell us a little bit about, Philip, the different types of deal structures and terms that a founder might expect, say be they equity or debt, etc. And are there certain things that they should look out for, that if an angel investor is asking for something, is that kind of a bit of a warning signal?
Okay, so I guess in the interest of time, I can't really answer that comprehensively, but let me try and answer it this way. When you come to us, or indeed me, for some seed money, my starting point is, how much do you want? What do you want it for? And as Debra mentioned, I want to see a credible plan. So I want to see what makes you think that what you propose is a good idea, what makes you think anybody will want it, what makes you think anyone will pay for it. So I want to see how did you get to the point where you thought this can be commercialized, whatever it is. Now talk to me about what the various milestones are between here and where you're headed. Now persuade me that they are credible and achievable, and explain to me how you've come up with what funding you need to reach each milestone. So a lot of our approach is really just getting a feel for what exactly is it that you want funded, and you know what it's for and at what stages. Assuming we get past that point, then you can talk about in what form you want this money. So, for example, if you're at a point where we can come up with a sensible valuation because you're sufficiently far advanced that you've got maybe a prototype, or you've done some market research and you can point to some sort of objective evidence of what the target market looks like, then you might be able to get a valuation, in which case we just want simple ordinary shares, same as you would probably have. If you're you know, pre-product and at a very preliminary stage where it's just, you know, you could almost lick your finger and wave it in the wind and you have no idea how to value it, then you might do a con note. And a con note is simply, we'll lend you the money until we get to a point where you can sensibly agree on a value, at which point that loan will convert to shares. So we don't basically want to lend money. We're not money lenders. We want to be shareholders, and we want to be, you know, we talk about angel investing being smart money. I mean, we could go and put money on a horse race if we, you know, we'd probably objectively get better returns than we get from some of our investments, because, you know, 8 out of 10 are generally going to be duds no matter what. But occasion you'll get your money back, and occasion you'll get, you know, 20, 30, 40. In my case, I've had a 50x return, you know, so you can get lucky, but it's a bit like throwing a dice, you know, tossing a coin. Everyone will tell you statistically it's a 50-50 chance of getting a head or a tail, but you might have to do 100 throws for that average, you know, so you might throw 20 tails in a row, which means you lose your dough 20 times in a row before you get a good one. So it's all about, you know, literally working out for a particular founder, for a particular deal, particular product, what makes sense. So we tend to prefer just straight equity investment, you know, and really only a con note if there's a logical reason why it's too early. I know people talk about safe notes. We really don't like safe notes to be honest. I mean, it really means I have no idea where I'm going and when. And we might do a safe note if there are some existing third-party investors and you know, everybody is doing it. So we might join in, but it's not our preferred mechanism. And you don't really want debt, because if we're going to lend you money, we'll want a pretty good interest rate, because it's basically completely unsecured finance, and you can't offer much in the way of security because you'll generally be already up to your eyeballs in debt from family, friends, and maybe even some fools. And you know, we're basically bridging you from that point through to VCs, who will generally want to wait until the deal's been de-risked a bit before they'll venture in, although a lot of them are putting their toe in the water now at this seed end of the market. They're getting a bit greedy and wanting those returns, but they're not fun to deal with. I mean, you know, and people say, I can get 10 million over in Silicon Valley. I say, yeah, well, we joke that if you walk down the street in Palo Alto, someone will jump out of the shadows. They won't mug you. They'll shove $10 million in your face. And in about 3 weeks' time, they'll come back and want to know where their 20x return is and kill you if you don't have it ready. So it's dumb money, which you don't want. So we are, yes, we do a strong due diligence, but we're really testing credibility. There's no real, people think they can be coached in how to pitch to angel investors. I mean, if you follow a script, you'll have no credibility. We're looking for a credible story. And the more modest, the more realistic it's likely to be. You know, it's no good coming in and, you know, if we might say, what do you think your exit will be? And they tell you they'll have an IPO in 3 years. Just say, no, you won't. Go away. You're stupid. You know, I mean, it used to be 5 to 8. It's now often 8 to 10, and just the time is longer. So you've got to be patient. But again, credibility, personality, and that's all we're looking for. And we work backwards from that into what form the investment will take. So, you know, there's it sounds complicated, but you're going to need to be raising money for 3 or 4 rounds. So once we've put in a round or 2, then you'll be wanting to go to bigger funding rounds. So your valuation has to keep pace with that. Otherwise, you haven't left anybody enough scope to have an investment that will deliver a reasonable multiple. So you have to kind of continually work backwards. And from the investor's point of view, we might put in between 10 and 50 in round 1. But again, people will want to be careful to allow themselves some headroom, a bit like a game of poker. You put all your money in at the beginning and someone wants to raise you, you've got no money left. So you end up being diluted, which is not the point of it. So you've got to pay to play, and you want to stay in. So again, you have to pick a number that you're comfortable with. So look, it's a long-winded answer, but you really need to build the answer out of where you are, what you want and why, and who you're asking. So there's no simple answer. I know it's a lawyer's answer, it depends, but it really does.
So, you know, I think this highlights the differences that we see across the angel community, because if you think of angels as a group, they're the most non-homogeneous group that I'm a market researcher by original business, and I've never researched a group that is less homogeneous than angel investors. You know, I think we tell the founder,
you can't all be outliers,
don't worry. Oh, you are, believe me, we are. I mean, the issue of dilution, we tell the founder not to worry about dilution, that having a smaller piece of a bigger pie is a better thing. I very seldom follow, because I want to give the next business a start instead. And why would I invest a much higher valuation and dilute my overall net return on the money I put in the first place? So, that's the first thing. But the second thing is this view about angels and VCs being in conflict. And I do acknowledge your point that VCs can behave badly. But as founders, I think we have to present the reality for founders that if this business takes off, there's almost no chance that angels will be able to fund it to fruition. And so we are going to together have to deal with VCs. And in fact, angels' experiences of dealing with VCs and working together to take the business to its next step is part of the value that we bring to the founder, in my view.
Yeah, and I think it's, as you were talking about before, there's all sorts of reasons why angels get involved and ways that they can leverage their money as well. And a big part of that is their expertise, as you're talking about there too.
There's a very specific question in the chat for Philip.
Yes, indeed. It looks like, I think he's maybe trying to answer that as we go.
I think we can't answer the questions ourselves. Panelists don't have access to everyone.
Okay.
I just answered one. I don't know if that there's some questions in the chat and some in the Q&A, but
yeah. I'm
okay.
For the moment I'm letting the questions be, and then we'll come back and do some
That's fine.
do some Q&A from the audience at the end, which will be good.
I guess it would be I guess it would be worth the audience knowing that if you put your questions in the Q&A, we can answer them as we go along, but if you put them in the chat, we can't.
Yeah, okay, that's a good point. I would say
one thing I'll just add to the previous answer is you've got to bear in mind that the motivation, as Debra alluded to earlier, is you invest in things that you're interested in and hopefully have a bit of expertise in, and so that you can give more than cash. You give some wise counsel, you might have good network connections that can help the business, so that it's quite a complex blend of how you help. It's not just raw cash, and so oftentimes that will also influence the form in which the investment takes. There might even be some sweat equity in there if you've got particular expertise that can help. So all those things go into the melting pot.
And can you explain for the audience what sweat equity is?
Oh, sweat is basically you earn shares by working. So effectively you get shares for effort rather than cash. But that's relatively rare. I mean, an angel investor is normally putting in cash and giving you their expertise and assistance free of charge. But if it gets to the point where it's you're doing a full-time contribution for some months, then you might want some additional equity to recognise that effort.
Okay, well, actually, it's a good segue to come back to Debra on the next question, which is we're talking about here the in a way the relationship between angels and investors, and the term was used previously and is thrown around a lot, which is smart money and what that is. It'd be great to hear, and maybe drawing on your experience too, Debra, some examples of how that relationship can be really maximized for all concerned, and like what's some practical things that you might do once you bring on capital, and maybe understanding that can help you when you're raising capital, kind of plan for that and articulate that you're wanting and have knowledge in being able to create a great relationship with your investors.
I mean, at every stage of your fundraising journey, you should be doing at least as much due diligence on your investors as they're doing on you. And by that, I mean, you should be talking to people they've invested in before to find out what sort of investor they are. Having some passive investors is not necessarily a bad thing, but you need to know that these are people who are not going to add any other value. Whereas if you get smart money at the table, what we mean by that is that you've attracted people who have skills, experiences, and in particular networks that can be of value to this business. So, you know, I'm thinking of a movie tech company that attracts money from past executives of the big Hollywood movie studios who happen to be living in New Zealand now. Those people they know everyone in the industry. They're able to make introductions at the appropriate time to potential customers. People who bring experience themselves of having grown a startup, having built a business, having built a team, how to build that tech team, what a product roadmap looks like, all those things that founders often have a small piece of the expertise or experience already, and they rely on others to bring that experience to the table. The other thing I would say is that if you take money from an angel group, you need to understand who that, or any investor group, you need to understand very clearly who that group is putting at your board table, because chances are that your seed round might often come with the requirement to create a governance board. And if you do that, the governance board is your new boss. The governance board doesn't have the ability to take away your shares normally, unless you behave really, really badly. But they do have the ability to fire you as CEO and replace you if things go badly. And so you need to be very comfortable with who's coming onto your board table and who's going to ultimately take responsibility with you for growing this business.
Could I just comment on that?
Daniel, I'm really interested in your views on how to pick your right angels.
Yeah, well, I was just going to say, just to comment on that, I think you're absolutely spot on. It probably goes back to your very first comment around, do you really want money from external parties? Because it does very much change the dynamic. As a founder, we obviously are very protective over our babies, and to bring someone else in, especially on a board that could potentially, as you just said, could potentially fire you as CEO, is a lot to deal with. It's like, well, hang on, it's my baby. I've built that from the start, and that's mine. How dare you come in and tell me how to run my business? And that's a really, really important point. When you're getting this external money, it's not just money. Yes, you're going to get help and guidance, ideally from that smart money from that angel, but it also comes with it a lot of responsibilities, because there is that additional element of that governance that comes into play, and you can't just do what you want to do or how you've always done it. And so it's a really important point that Debra just raised.
Yeah, great. And so from there, Daniel, I think it'd be great if you're able to kind of further elaborate on your own experience. I know probably slightly unusual, you might think, from many, because drawing from your success in your early career, but nonetheless, yeah, I'm sure everyone would be really keen to hear, from a practical way, how did you raise capital? What were the steps that you took, and yeah, how might they learn from those? And I'm sure many of in the audience, and we do find this at Founder Institute as well, have been very successful in their different careers. They might be successful small business owners, or in a corporate job, or in other regions in the world, and they've come to Australia or New Zealand, and they're looking to leverage the skills they have in a new market. So yeah, so keen to hear from you.
Yeah, sure. So I think it's been touched on a little bit by Debra and Philip in regards to, angels aren't necessarily investing in an idea or a concept, they're investing in people. And so, that's predominantly, obviously they want to have the concept or the idea in a space that is usually something that fits their portfolio or fits what they like. But for me, the number one thing that I've always focused on is around my personal passion to solve a particular problem. And, when you walk into a conversation with an angel with an attitude of, I am absolutely putting everything on the line here. I have total faith in this, that this is going to fly. And, you know, you walk into that conversation with that confidence around, I'm putting everything on the line here. I'm not expecting you to risk your money with me not risking anything. So, you know, I need to risk everything with you. We're in this together. So first and foremost, it's about that attitude that you're walking into that conversation. Secondly, I think it's obviously concept and idea definitely comes into play, because you know, usually, and I'm generalizing, usually the angels that I've spoken to have a particular sweet spot that they like to look at in particular domain areas or particular size investment, etc. So it has to fit the portfolio and fit what they're looking for. But the few key areas that often are forgotten, which are such obvious elements when you're sort of, you know, putting your pitch pack together and want to walk into a room and be very clear about what your opportunity is, you've got to make sure you identify what the problem is. What's the problem you're trying to solve? It's got to be clear and upfront. And that's first and foremost. You have to then you know, show your solution that's going to be a clear solution to solve that problem. How are you going to solve it? You know, what sort of competitors are there in that space? And then really making sure you build that argument. And, you know, Philip mentioned it before, you can't, you know, have crazy numbers to say we're going to be, you know, $300 billion in 2 years, or, you know, IPO in 1 year, whatever it is. Like, anyone can make numbers look amazing. Just have realistic projections. You need to make sure that the numbers stack up. So, you know, look at your LTV to your CAC ratios and things like that to make sure that those numbers stack up at a very base level, but then show the plan on how you can scale it. Yeah, and it has to be able to scale. And so that's all around your, you know, how am I going to make money, my go-to-market model, et cetera, and making sure that that all just stacks up. But ultimately, it very much comes down to you as a person and you as a team, and making sure that you've got domain experience in that space. And so, you know, for me, when I was talking before around pre-seed versus seed, you know, each time I've sort of moved into that seed phase, I've moved into that business full time. And that's a commitment, because, you know, at the end of the day, you know, angels are looking for you to commit to this business, and nothing can replace, you know, that founder passion. And if you're sort of saying, look, I'm going to do it on the side, I've got a cushy job here that I'm working in, and I'm just playing, you know, a bit of a game on the side over here, I'm not really that serious about it, but I want your money, I want you to risk your money, that's the wrong conversation. And it's all about saying, look, I've done some groundwork here, I've investigated this, I'm passionate about it, I know there's a core problem here that's not just me, that's a clear problem to solve, and I want to solve it, and I want you on that journey with me. I just need a bit of money here to help, you know, prove out the concept in an MVP or pilot or whatever it might be, and you're jumping in and taking that step. And that's kind of the way I've approached it. And you know,
can I just pick up on your point that, you know, this is a real problem, it's not just you. One of the things that I'm deeply allergic to as an angel investor is a founder that's solving a problem that they personally have. And the assumption that everyone else has this problem as well. And it's a huge market because I've got this problem. Yeah.
That's why it's fun to know what makes you think the world wants a solution to your problem.
Exactly.
And so
how does that balance, Deborah, with I know many investors, they there's a term that they use called the lived experience. So somebody who has kind of lived the problem and therefore are very passionate about it. Like, how does that kind of balance?
Yeah, necessity is still the mother of invention in many cases. So that's not a bad thing.
It is, but you know, I think if you've lived it too deeply, it can cause you to be blinkered. Whereas if this is something that you've worked in, or you have domain knowledge of this from other things you've done, I think that's more what I personally look for.
Yeah, I mean, if you come to me with the better mousetrap, I will question whether the world is dying for a better mousetrap.
Exactly. Yeah.
A bit of cheese and an old bit of string wire works pretty well.
Yeah, I guess the ultimate thing that you're saying there is market validation that it's a problem, but the problem is likely to be something that a wide market needs.
That's what I was just going to say, is the validation element. Yeah, like, because often problems come about through your work or through your experiences or being a customer, and there might be a problem that you see as a founder to solve. I don't think Debra's saying that's a problem. It's more so saying that, if it's only a problem for me because I live my life a certain way, and as a customer I expect this, that's an issue. But if you've done that, and the concept or the idea has come from that experience, you've then really got to the root cause of that problem, and then validated that to some extent in market to understand, well, it's not just me, a lot of people have this problem, and so it's a common problem. There's a need for some sort of solution, and here's a solution that could solve it for all, not just solve it for me personally the way I want it solved. And that's kind of the difference, I think.
I also want you to have checked. I also want you to have checked that the problem hasn't already been solved.
Exactly. Yeah, exactly.
Yeah, good point. Indeed. Okay, fantastic. All right. Well, it's a good segue for a final question before we throw over to the questions from the audience. So I'll direct this one to Philip. So there's some things that were coming up there around different potential kind of traps that a founder might get into or present themselves with. Keen to hear, Philip, I guess combination question. One, a bit more about your process at Sydney Angels. We heard from Debra about how things run at Flying Kiwi. And also, like, are there some common red flags or gotchas that founders may have, or startups that you see, and that people can be aware of and maybe hopefully address in advance before going and looking to raise capital?
Yeah, so some basics are, don't assume that if you can show us what you think will be a good business, that will invest. A good business doesn't make a good angel investment necessarily. You might come to us with a brilliant business idea and we think it'll be very successful, but it won't be an angel investment. Angel investment has particular criteria that are somewhat narrower, and going back to Debra's somewhat more mercenary description, but it has to be scalable quickly. So things that have quite difficult physical fulfillment will tend not to be an angel investment. You could have the world's most brilliant product, but if you've got to build a global distribution network to sell it, that's not going to be an angel investment. You just can't scale at the speed you need to get the sort of return on the cash that you've got to spend to do that exercise. So that's the kind of thing people don't really understand. And that doesn't mean that it has to necessarily be quick. So I invest in quite a lot of biotech. I mean, my 50x return was a 12-year investment. But that's because you've got to go through clinical trials, but you know the path, and the milestones along the way tell you that you're still on track. So having, again, comes back to a credible story, being able to articulate milestones, being able to explain what you want the funding for at different stages. You don't need $1 million on day one, because your first milestone won't cost $1 million to reach. So we might be very happy to give you a couple of $100,000 if you can show that that's to build a prototype, and you've got a very credible idea. Normally we prefer to have a prototype, and so it's more to commercialization. It might be to get some patents. I tend not to like patents, but that's from being an intellectual property lawyer for 50 years. I specialized in revoking patents for generic pharmaceutical companies, but that's another story. You really want something that no one can reverse engineer when they see it. That's the best. Keep it secret. If Coca-Cola had patented their formula, they would have only had commercial success for 20 years. By keeping it secret, can go forever. So, you know, and people say you can do a mass spec on my mother's cake and find out what's in it. I said, that's true, but you won't be able to reproduce her cake. The mass spec won't show you that flick of the wrist in the stirring it between the egg and the milk and whatever it might be. It doesn't tell you anywhere near what you need. So keep it a secret, and that's the best of all. But yeah, look, there's no people looking for a magic formula or magic script that they can follow. It doesn't work like that. It's credibility, personality, dumb luck. You know, I think they did a survey about what the secret to startup success is, and they realized it's about 70% dumb luck, you know, and 29% commitment and perseverance and tenacity, and 1% a good idea, you know, roughly that sort of proportion. So you just got to run with it. And use your angel investors. And again, I mean, we're very strong on post-investment management. So as well as investing, as well as doing the due diligence, we become your advisory board. We are your mentors. You know, we've gone into it because we have a genuine interest. You know, I'm passionate about Aussie innovation or Kiwi innovation or whatever it might be. We're very per capita inventive. It started out, I guess, the tyranny of distance, where we would improvise because we had to. You know, I often joke that you give an Australian and an American a screwdriver, and the American will wait for the screw, whereas the Aussie will jemmy a window or stir the paint with it or do something it was never made for, because you can and you have to, because you don't have the paint stirrer or the you know, jackhammer or whatever it might be, or the chisel. So you just use the screwdriver. So we're very good at being inventive, and the Kiwis are the same. We come from an inventive part of the world. We love that stuff.
I think, if I'm not mistaken, is it a number 8 wire or a number 5 wire? Is that the
exactly
term, Debra?
That sort of thing.
Similar.
So, but just to come back, I guess, to Chris's question and the way Sydney Angels works, we get about 40 applications a month. We don't charge anything for people to apply. It's just on the website. And then our committee every Friday morning just has a look at the deals that have come in the last week, and we screen out those that are just someone's fantasy and those that look like they might actually be a deal, and then so they stay in the running. So we do about a 6-week cycle, and then at the end of that we invite what we think are the top 6 to come to a more formal deal screening meeting, which is 10-minute prezzo, 10 minutes Q&A, and then we pick the top 3 of those to go through to a full members meeting, which again is 10 minutes prezzo, 10 minutes Q&A, and then it's just up to the members. So we have about 110 high net worth individuals who will just individually decide whether they like a deal. So we normally fund 2 out of 3 at a members meeting. We also have a sidecar fund, which is something we pretty much invented, although others have tried to copy, which is basically a managed investment fund, but the investment committee doesn't decide on investments out of the blue. They simply match dollar for dollar what the Sydney Angels syndicate has put in. So if you come to us needing $500,000, we actually only have to put in $250,000 between us, and the sidecar fund will match us. And what the management and investment committee of the sidecar fund does is simply satisfy themselves of the quality of the due diligence we did. And basically, like a sidecar on a motorcycle, they just go wherever we go.
Yeah.
But that's basically our MO.
But so you've got an incredibly high hit rate of funding to, I mean, you're saying out of 40 applicants, you would fund 2 or 3.
Every second month, we would probably fund 2 out of that original 40. So or by then it's probably almost 60 to 80. So yeah.
the New Zealand data shows that out of every 100 companies screened by Angel Group, 6 get investment.
Yeah, that's probably not that much different to us, but as I say, we have. I mean, our portfolio now. We started in 2008 at the GFC. For a couple of years, the VCs just disappeared. So you could only get funding from Sydney Angels and some other angels. We're the largest angel group in Australia. But yeah, that's how we operate. It's proven pretty successful. You know, we've got a lot of household names now that have listed, but yeah, you've got to be patient. You've got to persevere. Again, perseverance is sitting there as a reminder, and the ingenuity is also there to. You need something. You know, you do need a secret sauce. But don't come and ask me to sign an NDA. That will turn me away. If you know, because if I see 40 deals a month, I'm too old to remember what I saw where and when and what I can and can't say. So if you can't tell me enough to make me invest, that's tough. Go to somebody else. I'm sorry.
Yeah, and it's interesting how efficient really it can be going through different angel groups. Of course, there's many ways to do it, but yeah, one of my companies that I successfully raised angel investment for, I raised through a similar group in Colorado, and yeah, very effective. And in addition to getting the introductions through, another value add just of going through the process was they provided different coaching and training through the process, and they kind of help refine your proposition even further, of course, and really go to that next level.
I mean, interestingly, I mean, people often ask about, you know, should they just go over to the US and you know, try and get someone jumping out and giving them their 10 or 20 million, but we've found that the good angel groups over there actually highly value people who've had a round or two from an Australian angel group, because you know they know they've been de-risked, they've had a good DD done on them, so they're much more likely to actually now have a closer look at you. And we have good relations with a lot of angel groups, particularly on the West Coast, that we can refer people into, but we refer a lot around Australia. I must confess, Deborah, we haven't done referrals to or received any from Flying Kiwi Angels, but maybe that's something we should give some thought to.
No, the guys at the Brisbane Angel Group invest in New Zealand deals occasionally.
Yeah, they have a very different model. They have a sort of a bare trust, which dribble about $5,000 into everything. So they have an interesting model as well. Everyone has their own.
Everyone has their own model. Yeah, there's you got to be in every deal model.
Outliers. I'm not sure what a professor of statistics would say about that conceptually.
Well, yeah, if you think diversification is what's going to deliver the returns, then the spray and pray model is actually quite effective.
Yes, it is.
I always say I prefer to make my own mistakes rather than outsource them.
Yeah, I mean, crowdfunding's also, you know, now comes into the mix where it never used to. We have arrangements with quite a number of crowdfunders to top up where we like this and can't quite get the amount needed. So there's a lot, you know, there's an ecosystem now where don't assume everything you need to get from your angels. They can refer you to other angels, share deals.
We also have early stage VCs here that are investing at seed stage as well, and becoming more active as
the Victorian government's just given a few $1 billion to invest in stuff. So
and I mean, as the competition for deal flow, particularly in the last few years, not very recently, but in the last few years, as the competition for deal flow became more intense, we saw more of the Series A VCs deploying some of their funds into the seed stage to buy themselves a ticket to play in the next round.
Yeah, different.
Yeah, again,
different movements in the market.
If you what you don't get with those, you'll get their cash, and they'll want the same sort of returns as angels, but it's not smart money. There's no. It's a fund manager behind it, not a person with a genuine altruistic bent on helping you because they like it. So again, again, it's horses for courses.
True, but sometimes they do bring different types of smarts to the table. Because they do have experience amongst the LPs in that type of tech.
Yeah, I think many of them would argue that they do bring a lot to the table, but then it's up for personal debate on that. Now we might jump on to questions. Got around about 20 minutes left of our allotted time for the session, and so it'd be great to now jump into audience questions, and just reading the first one here in the Q&A. So from person with handle Assetly, bit of a technical question in relation to preference shares and how you may have the situation of successive rounds. As each round an investor is coming in, they're wanting effectively a slightly sweeter deal to those that came before. I'll throw it out to the panel and just ask: is there any way that can be avoided, or what do you think of this?
The simplest way of avoiding it is to say no. But if you're absolutely desperate for cash, and the only way you can get the cash is to agree to the condition, you're going to end up agreeing to the condition. So ultimately, it depends on your bargaining power. The ideal is that everyone gets, basic, simple, straight, normal, ordinary shares. But you do sometimes get to a point where you can't get cash from anyone except on a preferential basis. So you end up having to agree. But your early investors don't like that, because again, you're increasing their risk.
And what are preference?
Try and get more money out of your existing investors. Really, it's a last resort to get this kind of leapfrogging preferencing. It really annoys everybody pretty much.
Okay, maybe Debra, one for you.
Yeah, I mean, what you say, what are preferences?
Just for people
in layman's terms, it means that the most recent money in gets their money out first in the event of a closure before anyone else. So as founders, you're at the bottom of the tree, and if you've taken more money in than your company's worth, it goes to the people with preference shares first, and you could get nothing. Or your early stage your angel investors could get nothing if there's sufficient stacked preferences from later rounds. But the reality is that there's very little way to avoid it unless you over-deliver on all your milestones at every round. And I have got an example of a company that was started here in New Zealand that has moved all the way through to unicorn status without ever having to take preference shares from investors. And they've been through many, many millions and millions of dollars of capital to build a global business. But they have always been seen as a company that is super successful, with a very charismatic founder who is driven and ambitious and simply is aiming for the stars. And between him and his original angel investor champion, who is still with him, the two of them have negotiated through every deal without any preference shares. I mean, I'm imagining, Daniel, that company number 8 is not having to give investors preference shares.
No, that's correct. It was a very different path, but it was a lot more involved, and a lot bigger check. So quite a different path.
Success solves a lot of problems.
It does. Track record.
And I guess, as Philip mentioned, at the start, like that negotiation position, because effectively it's a negotiation. All right, we might move on to the next question.
Sorry, Chris. I was just saying, it was mentioned before around sort of founder credibility. I was just also going to say the reverse is very true. And you kind of mentioned it as well around, you get a key angel investor involved in your business. That actually adds a lot of credibility to your business as well, and also to future funding rounds.
And every angel group has a lead sheep. Every angel group I've ever worked with has a person who, if they're investing, all the other angels want to be in the deal. I always call that the lead sheep. I suppose in Australia it's called something different.
That's a very New Zealand analogy.
That's a good one. And actually,
if you can find the lead sheep, you're in.
Yes, there's something I was going to maybe mention before, is just the concept of the lead investor. Yeah, maybe throw that to Daniel. Like, what is a lead investor and why are they important?
Yeah, look, for me, that, you know, it was kind of just mentioned there. They're sort of the lead investor. Usually is the one that takes the share of the load and the DD, et cetera, et cetera. So they're the ones that do a lot of the heavy lifting. And so that lead investor, in my experience, are the ones that you want to get on board. You want to obviously treat them well. You want to obviously make sure that that you get them on board, because then others will follow on behind. And sometimes as that lead sheep leading the way, others just follow on and assume, well, hang on, all the work's done by that person, and I'm confident in their abilities to do the due diligence well, and then I'll follow on. So that's usually the way it has worked in my experience. Okay,
great. All right, we might jump on to the next question. Interesting one. So this is one from Alan. Are you likely to view a high-tech venture? So I guess that's kind of deep tech, high tech, which is typically hard to execute. That does have a huge market, with trepidation, excitement, or both.
But if you don't tell me more than that, it'll be go away. You know, you've got to explain.
I mean,
what makes it potentially huge? What is the market? You know, as I said before, you can't just come with a glib proposition like, tell me what the total addressable market is globally and you'll IPO in 3 years. That's not credible. Just, you know, we have an appetite for everything that's a good angel investment, and what's a good angel investment, we'll know it when we see it.
Yeah, and I mean, I must say, in New Zealand, there's a significant shift out of mainly software investments into deep tech and hardware-enabled software, but also software-enabled hardware like Upco bikes.
Yeah, I mean, AI is obviously, you know, a bit of flavour of the month, but, you know, there's some very clever stuff that's being AI enabled. So yes, I like that stuff, but only if what you've got is still a good story.
Okay, great. Well, I think I'd summarize that answer as maybe, but more information, please. So it's not a no. Okay, great. So next one from Zahar. I might summarize this. I think essentially it's about how do you find investors that match your business, and yeah, are there places to go to do that, and yeah, how do you determine what is a match? What are some of maybe the characteristics?
I think in the extreme, if you're in a very, if you're in like medtech or pharmaceuticals, then there's certainly fewer investors and it's easier to hone in on them. But remember my original contention that angels invest in the people. And so it's quite unusual to find angel investors, certainly in my circles, that only invest in specific industries. One of the deals that I led for Flying Kiwi Angels was an orthopedic surgery software business, AI enabled, Philip. And, I championed the deal to Flying Kiwis, and I stood up and I said, look, I know you know me. I know I'm an engineer. I know nothing about software. I know nothing about orthopedic surgery, but I'm backing this deal because this founder is the most intelligent person I've ever met, and he is going to make a success of this business. And so if you'd looked at my portfolio, you would have said, there's no chance I'll invest in this. Not only did I invest in it, but I was the lead investor, did the due diligence, and went on the board. So, it's almost, It's doing great. I'm no longer on the board. When it got to Series A, I stepped off and gave my board seat to someone who was more able to take them through the FDA approval process. The product is launched in Australia and New Zealand.
Yeah,
So,
I mean, look, we are sufficiently diverse that if it's a good angel investment, somebody will be interested enough in it, and if they're interested enough in it, others will be interested in it. So again, the test is it a good angel investment rather than,
yeah.
I mean, if nobody has any interest in it, that generally means, you know, with our diverse membership, that we don't think it's a good deal.
Exactly. You know, I come from a data background work-wise, and I used to think that it would be possible to build an algorithm that would look at all our members, what they'd invested in so far, and be able to look at a deal and say, right, the people this deal needs to talk to are these 3 people in the club. It's not possible. It doesn't work like that.
Just a slightly different view. So, and please, my experience is only very narrow to the other panelists, but yeah, I've definitely worked with angels that are very prop tech specific sort of angels. There's definitely diversity in all portfolios, and I think as Debra said, like, you know, certainly if there's just a business an angel may not know anything about, but they just love the passion of the founder, and they're likely to go with something there. But generally, in my experience, with the few I've been involved in, they've been fairly heavily prop tech focused, but with random things around the outside to diversify the risk. But to sort of answer that question directly, I don't know, Philip and Debra, do you think, apart from saying obviously approach any any angel, and if the concept fits for this particular logistics and supply chain opportunity, that's great. But do you know of any that might sort of specialize in that area, or have an interest in that area?
We're interested if it's a good deal.
Yeah, exactly. You know,
I think, come and apply, and we'll tell you if we're interested. We don't put labels on them. We don't decide by labels. We decide by the criteria I earlier referred to.
Also, remember that you can do some research on who's invested in what businesses. It's not always apparent, but sometimes it's listed at the company's office if they're not in a holding trust of some sort. Sometimes there's been press releases that talk about who's invested in this business, businesses like yours or in the same space as yours, and so on. Just do some research.
I mean, look, certainly on the angel side, I think there might be a few that tend to specialize, but what you're seeing more of now, I think, are specialist funds. So, I mean, if you take just an example, Venture Crowd in Australia now have a health tech fund and an ag tech fund and a food tech fund and a fintech fund. So you're getting sort of specialist funds that are looking for particular kinds of things, and that way the mums and dads who want to invest in crowdfunding can pick things like that. So you are starting to see a little bit of that, but I think in terms of angel groups per se, there's not many. I mean, Hunter Angels in New South Wales have a predilection for biotech, for example, but again, you can't generalize. In fact, they sent us a very good mining industry deal, which we all love and all invested in. So you just can't, if it's a good deal, it's a good deal. We don't care what it is. I mean, spaces is also another kind of flavour, but again, hard to get a good angel deal in that space, no pun intended, because they're long lead times at the moment.
And what about geography with regard to investing?
That's a really interesting question. I mean, we used to have, and one of the reasons we're called Sydney Angels, when we first started back in 2008, we had this kind of informal rule that if you can't get to the founder's business within an hour's drive, don't invest in it. But that was all pre-COVID, pre-Zoom. Now we invest in things all over the place, and you can comfortably, be very close to people as we are now.
I think it depends. For me, it's my purpose is very much about growing high value jobs in New Zealand, and so I tend to only look at New Zealand born startups personally, but I will say that there are tax implications of investing offshore for angels and everyone else, and so that's part of what limits geographical reach of angel deals.
Yeah, and certainly in Australia, the early stage venture capital regime doesn't accommodate offshore investment.
No, exactly.
Yeah, I think that's been my experience, that it's more the exception rather than the rule that angels will invest outside their home country.
Their country,
Not always the case, but and I think another thing too with angel investors and all investors too, typically they'll invest in things that they understand. Probably be a bit foolish not to, but having said that, I think as you're all saying, it's very much the onus is on the founder to help them understand why is this going to be a good opportunity.
But from the reason you invest in something you understand and know a bit about is so that you can offer some wisdom and mentoring and make an intelligent contribution to the problem solving and things like that. So, I mean, if you invest in something you know nothing about, you're not going to be able to add much to your dollars. You might as well put it on the stock market.
Indeed. Now, I've got two more quick questions before we wrap up, and then we've got the opportunity to jump over to some virtual networking, which we'll post the link in for. So the first one is from Harry in Melbourne. He's asking about, is there something kind of specific around how you know if an idea is a good or bad idea? Is there a size of the market that you need to have validated with before you know that? And is there a specific process that you can maybe point him to on how to do that?
I can mention from sort of my experience, Chris, if you like. In terms of that exploration. Yeah, so for me, there's no one way to build a business, right? In terms of, obviously they're quite different in terms of the opportunities and how to sort of size up opportunities. But in terms of the first part around, sample size, etc. Look, it does depend on the total market. So if you're looking at a TAM that's massive and it's global reaching, you want to have a sample size that's a decent representation of that. But I've done sort of validation exercises, qualitative and quantitative, on sort of sample sizes of 500 people, 1,000 people sort of sizes. If you're getting really good metrics around that this concept's testing very, very positively, 70, 80% plus kind of thing, that's a pretty good confidence level that you've got something there that could be worth solving. In terms of the second question there around an exact process to validate, look, there's frameworks that you can follow and things like that. It does depend on the business. My usual process, for sort of validating is really going down a DVF path. So desirability, viability, feasibility. It's just a good framework to sort of look at. So yeah, jump online and dive into that one. But high level, is the problem worth solving? Is it a desirable type of solution? So that's that demand element. Is it a need that needs to be served? Is it something that the metrics work and the business model can work, et cetera, and can be scalable, and is it something that's real? Is it something that, you can deliver on, that you or a team around you, or, you've got access to the resource to actually deliver on that? So that sort of DVF model is usually one that's pretty common, that I've used pretty much most times.
I mean, our process is a bit more ruthless, I suppose. We have our Friday morning meetings. You need, and we only rate a deal maybe or no, and you need more than 50% of 20 people to say maybe. If you can't get 50%, if you can't get 10 people who say maybe, then you failed our market validation. And we may be wrong, you know, but
investor validation.
That's our process.
So I put my market research hat on and say, showing your concept to people and asking them what they think of it is not the right way to do this, because frankly, everyone is too kind and too supportive. And unless you're asking them to hand over money, that's a stupid way to validate. What you need to validate is that the people who you're going to sell this to believe there's a problem. So in the example of Alan and his aging in the home example, he told us what the business is in the Q&A. I want you to go talk to old people living in their own homes and ask them what problems they have living in their own, aging in their own homes, and how they're currently solving those problems. Because even if your problem is something they recognize as a problem, if they're not doing anything to solve it now, chances are they're not going to buy a solution. But if they've tried to solve it in 6 different ways and they still haven't found the right solution, then your solution might be validated.
Just to pick up on something Debra said there, which was a really important point. So yeah, when you're validating, or when you're interviewing, whatever it might be, when you're researching your problem or the concept, talking to someone, obviously they have to be a potential client or something, otherwise their answer is quite irrelevant. But when you're talking to them and you're testing a concept and say, what do you reckon about this? Would you like, do you like this? Would you buy that, etc., etc.? Often, as Debra said, they would say yes. It's like, yeah, I think that's pretty cool, because they don't want to be rude. That doesn't really tell you whether this is going to be a flying opportunity or not. You then have to flip it and go, well, okay, please give me a credit card and I'll be charging you X, Y, and then it's, well, hang on a second, what are you selling me here? It's a very, very, very different question. So you can validate by sort of concept testing, which is part of it, but then you want to validate for real. So go set up a website. And then actually go and try and sell it. Don't have the service or product behind it. Go and set up a website, start selling it, and people say, whatever the thing might be, product, service, whatever, and then put your name here, register here, to actually buy it, be one of the early bird specials, whatever it is, for X dollars. That'll tell you whether they're going to pay for it or not.
Well, in fact, often a tangible way of doing that is to do a Kickstarter or Indiegogo or whatever. If you show that you've reached your target in 10 minutes and 4,000 people oversubscribed, that's a pretty good market test for me.
Yeah,
this is music to my ears, because I was having this exact debate with a founder just last week, and I'll be sending him the recording of this afterwards.
I mean, I will often fund people into a Kickstarter campaign if I think it's the right way to go. I've had a couple I've done that way, and that's just been a milestone. And if they achieve that, then they get more cash, and if they don't, we all agree that it was a good idea, but the marketplace didn't seem to agree. So
yeah, definitely ultimate validation. All right, one last quick question, which I'm sure you'll be pleased to answer. Is I can't see where it's there now, but it was there a moment ago. It was around accepting a salary from so say you are successful in raising funds from angels. Is it okay to pay yourself a salary? And maybe dare I ask, like, what kind of salary ranges, if there's any actual guide to that?
Don't be greedy. I expect you to live off bread and water for 3 years before you get my money.
So I expect that the salary will be enough for you to be able to focus on the business totally. And that means that it'll be different if you're a 21-year-old recent graduate living at home with your parents than if you're a married person with 2 children and a non-working spouse. So I want to know that we're paying the founder enough, but obviously it doesn't pay for pony clubs or private school fees or holidays abroad and things like that.
I totally agree, and that's why some people think starting your own business is going to be a get-rich-quick scheme. It's far from it.
Yeah,
it's a lot of hard work, and you get paid a fraction of what you should be paid in market. So, often
totally.
a lot of the founders, are in cushy corporate roles, as was I, and it's a massive risk to jump into startup world. I always say that founders have to have a little bit of crazy in them to do it, and to obviously take that leap of faith. But when you do that, your salary is going to come down in a big way because you're getting equity, right? So it's that balance of salary down, equity up, and it's a high risk but high potential return.
Yeah, I know a founder who keeps reminding his investors that if he went back to corporate, he could earn $500,000 a year. I don't care. Just like I don't care how much money and time you've poured into your startup when we're discussing valuation. That is entirely irrelevant.
But to answer the question, definitely it's fair to for a founder to get the salary, but it's got to be a
absolutely
very reasonable low salary.
You still want to see the founder have more skin in the game than they expect you to put in.
That's what I was saying at the start. It's all about that risk. If you want to show the angel that you're willing to risk your job, jump into this full time, as Debra said, it's about, making sure that you dedicate and focus to something full time, but not in a cushy way that you don't really care if it, it grows and gets a massive multiple.
Fantastic. Now I'll move on to wrapping up now. Just before we do, I've got one quick question for each of our panelists. Short one. Any resources or suggestions, books, websites, podcasts, anything you like that you think would be good to point people to learn more about raising money from angels or venture capital generally?
Well, certainly we do a lot of presentations. So I've put in the in one of the answers, I've put a link to a presentation we did in the Spark Festival called How to Value a Startup that a few people asked about. But we've got half a dozen presentations that you can find in Spark and other places like that. So just ask and we shall tell you.
Yeah, I mean, there are lots of books. There's a lot of resource on the New Zealand Angel Association website. And probably the key thing I would say is, there are literally thousands of pitch presentations online from companies that have raised. There's what a bad pitch looks like. There's what a good pitch looks like. All of that stuff is incredibly valuable if you just do some research and take it in. I'm not a great fan of telling people to read giant terms. So and talk to other founders. Now when you go into the networking, share your experiences with each other.
I haven't sort of read the manual on angel investment, but not that there is one. But coming from the founder side, a book that I always recommend is The Lean Startup by Eric Ries. So it's just a good book in terms of principles of starting up, a business. But it does have elements of funding linked in there. But that's definitely always a book I would recommend.
All right, fantastic. And one for me, I feel I'm allowed to ask myself, is a podcast called Angel, funnily enough, by Jason Calacanis, who's a prominent angel investor in Silicon Valley. So I find that very interesting to listen to. It's actually pitched at angel investors as the audience, but as predominantly a founder, I do a little bit of investing, but mainly as a founder. it's a good way to understand what angels are kind of looking for, and how you might understand how they think, and how you can best work with them. So with that, want to extend a huge thank you to you, Daniel, Debra, and Philip, for joining us this evening. Very, very much appreciate it. And thank you so much for sharing all your wisdom and giving up a Tuesday evening